Don't have $1 million yet? Follow Warren Buffett's advice. Welcome to the Investors Community channel. If you enjoy our content, be sure to hit the like button and subscribe for more valuable insights. Warren Buffett, known as the Oracle of Omaha, has a simple yet profound investment philosophy. Let's explore how you, even if you don't have $1 million yet, can follow in this legendary investor's footsteps. One of the biggest mistakes I see new investors make is trying to get rich quick. They often get caught up in the excitement of the market. They're chasing those hot stocks, trying to time the market, and end up losing more money than they make. This approach is not only stressful but also unsustainable. But Warren Buffett, he's all about the long game. He understands the value of patience and consistency. He says the stock market is a device for transferring money from the impatient to the patient. This wisdom has guided many successful investors. It's about building wealth slowly and steadily over time. Just like a plant grows with consistent care, your investments need time to flourish. It's about finding those solid companies that are going to be around for the next 20, 30, even 40 years and holding on to them. These are companies with strong fundamentals and a proven track record. Even if you can only invest a small amount each month, that's okay. Every little bit adds up over time. The important thing is to start early and let compound interest do its work. The earlier you start, the more time your money has to grow. Think of it like this. If you invest $100 today and it earns a 7% annual return, in 30 years, you'll have over $750. That's a significant increase from your initial investment. That's the power of compounding. It's like a snowball effect, where your earnings generate even more earnings. So, my advice to you is this. Don't get caught up in the short-term noise of the market. Stay focused on your long-term goals. Focus on the long game, and let compound interest work its magic. With patience and discipline, you can achieve financial success. Now, let's talk about what to invest in. This is a crucial step in your investment journey, and making the right choices can set you up for long-term success. Warren Buffett has this famous saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This wisdom has guided many successful investors over the years. What he means by that is, don't just chase after cheap stocks. Cheap stocks might seem like a bargain, but they often come with hidden risks and uncertainties. Instead, look for companies that have a strong track record of profitability, a solid management team, and a competitive advantage in their industry. These are the companies that are more likely to weather economic storms and continue growing. He calls this an economic moat. This concept is central to Buffett's investment philosophy. Think of it like a castle. Just as a castle is protected by its moat, a company is protected by its competitive advantages. The wider the moat, the harder it is for competitors to attack and take over. This means the company can maintain its market position and profitability over time. Companies with wide moats are those that have something special that sets them apart from the competition. This could be due to their brand strength, unique products, or loyal customer base. It could be a strong brand, a loyal customer base, a unique product or service, or a combination of these factors. These elements create a buffer against competition and market fluctuations. Now, finding these companies takes some research. You need to dig into their financials, understand their business models, and assess their competitive landscape. But here's the good news. You don't need to be a financial expert to do this. With dedication and the right resources, anyone can learn to identify solid investment opportunities. There are tons of resources available online and in libraries that can help you learn about different companies and industries. From financial news websites to investment books, the information is at your fingertips. Remember, Warren Buffett has held on to some of his investments for decades. This long-term approach has allowed him to benefit from the power of compounding. So do your research, find those companies with wide moats, and be patient. Investing is a marathon, not a sprint. With the right strategy, you can build a portfolio that stands the test of time. Alright, so you've started investing, you're focusing on the long term, and you're picking solid companies. Now here's another key to building wealth like Warren Buffett. Reinvest your profits. This is something I'm super passionate about because it's how you truly unlock the power of compound growth. Think of it like a snowball rolling downhill. As it rolls, it picks up more snow, getting bigger and bigger. Reinvesting your profits is like adding more snow to that snowball. Every time you earn a dividend or your investments increase in value, you have a choice. You can either cash out and spend that money, or you can reinvest it and let it compound even more. Now, I know it can be tempting to spend those profits, especially when you're first starting out, but trust me, the more you can reinvest, the faster your wealth will grow. Even if you can only reinvest a small percentage of your profits each year, it will make a huge difference over time. Reinvesting is one of the most powerful tools you have for building wealth, like Warren Buffett. Chapter 4: Minimize costs and trading fees. Now let's talk about something that a lot of people overlook when it comes to investing fees. These seemingly small charges can add up over time and significantly impact your overall returns. You see, fees can be silent wealth killers. They might seem insignificant at first, but they compound over the years, eating away at your hard-earned money. They eat away at your returns over time, and the worst part is, most people don't even realize how much they're paying. It's like a slow leak in your financial boat. Warren Buffett understands this better than anyone. He's made a career out of being mindful of costs. He's famously frugal, and he avoids unnecessary costs like the plague. This frugality extends to his investment philosophy as well. And when it comes to investing, he's a huge advocate for low-cost index funds. These funds offer a simple and cost-effective way to invest in the market. Index funds are like the workhorses of the investing world. They provide a reliable and steady way to grow your wealth over time. They're designed to track a specific market index like the S&P 500, and they do it at a very low cost. This means you get broad market exposure without the high fees. This means you're not paying high fees to a fund manager to pick stocks for you. Instead, you're keeping more of your money working for you. Instead, you're getting broad market exposure at a fraction of the cost. This can make a huge difference in your investment returns over the long term. And over the long term, low-cost index funds have consistently outperformed actively managed funds. This is because they keep costs low and stay invested in the market. So how can you minimize costs? The first step is to be aware of what you're paying. First, pay attention to expense ratios. These are the annual fees that all funds charge their investors. Look for index funds with expense ratios below 0.1%, or even lower if you can find them. The lower the expense ratio, the more of your money stays invested and working for you. Chapter 5: Research carefully before investing. Alright, let's talk about research. Now I know what you might be thinking. Graham, research? That sounds boring. Can't I just invest in what everyone else is investing in? And look, I get it. Research can seem intimidating, especially if you're new to investing. But here's the thing. It's absolutely crucial if you want to succeed in the long run. Warren Buffett is a voracious reader. He spends hours every day poring over financial statements, reading books, and learning everything he can about the companies he invests in. Start by reading the company's annual report. This is like a company's report card. It tells you everything you need to know about their financial health, their management team, their competitors, and their plans for the future. The more you know about a company, the better equipped you'll be to make informed investment decisions. Now, this next piece of advice from Warren Buffett might surprise you because it's not about picking stocks or investing in companies. It's about investing in yourself. That's right. Warren Buffett has said many times that the best investment you can make is in yourself. Think about it. Your skills, your knowledge, your ability to learn and adapt. These are your most valuable assets. And unlike stocks or real estate, these assets can never be taken away from you. They're yours for life. So, how do you invest in yourself? Well, it starts with education. Read books, take courses, attend seminars, and never stop learning. The more you know, the better equipped you'll be to make smart decisions, not just in your investing life, but in all areas of your life. All of these experiences will make you a more well-rounded and adaptable individual. Now, this next piece of advice from Warren Buffett is all about thinking for yourself. You see, Warren Buffett is famous for his independent thinking. He doesn't follow the crowd, he doesn't get caught up in hype, he makes his own decisions based on his own research and his own analysis. And here's the thing, this is especially important when you're investing. There's a lot of noise out there. There are analysts making predictions, news headlines screaming about the latest market crash, and everyone seems to have an opinion on where the market is headed next. But here's the truth. Nobody knows for sure what the market is going to do. So what can you do? Tune out the noise. Do your own research, think for yourself, and make your own decisions. At the end of the day, the decision of what to invest in and when to invest is up to you. Alright, let's talk about something that's often overlooked when it comes to investing: your mindset. You see, investing isn't just about numbers and charts and financial statements. It's also about psychology. It's about managing your emotions, staying disciplined, and not letting fear or greed get the best of you. Now, Warren Buffett is famous for his calm and rational demeanor. He doesn't get rattled by market swings. He doesn't panic when the market crashes. He knows that the market goes up and down in the short term, but over the long term, it tends to go up. And here's the thing, you can develop this same mindset. It starts with understanding that investing is a long game. There will be ups and downs along the way. There will be times when the market tests your patience. But the key is to stay the course, stick to your plan, and not make rash decisions based on emotion. Remember why you're investing in the first place. Focus on what you can control. And finally, don't be afraid to seek help if you need it. You know guys, I used to think that people like Warren Buffett, they were born with some kind of investing superpower. But the more I learned about his strategies, the more I realized that his success isn't about being a genius. It's about discipline, patience, and sticking to a few core principles. You don't need $1 million to start investing like Warren Buffett. The keys are patience, discipline, and persistence. The very qualities Buffett has embodied throughout his investment career. See you in the next video. Don't forget to subscribe to not miss out on more helpful videos.